Hey guys, welcome to another edition of the Trade Genius Podcast. Bob and Phil here as always. Hope you're having a great weekend. Guys, this is 2008 on steroids. We're going to show you exactly why. Buckle up.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes. And if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. Bob, why is this 2008 all over again?
Yeah, it's interesting. I'll answer you with with a story. So my father-in-law, it's interesting because my mother-in-law and my wife are very, very super financially conservative, but my father-in-law had a very lackadaisical attitude towards money. And I've always asked him why. And he's like, look, I'm going to spend, and really when it comes to the end, we're all going to be doomed anyway because we're just going to all jam up our credit cards and just let them reset everything. And I was watching yesterday the news of being haunted by my father-in-law because if you pop this next graph up, we had an incredible surge in credit card spending. I think it overwhelmed the estimates, Phil, in terms of how high it went. And if you show the graph here to give you a kind of perspective on it, look at this move.
Wow.
I mean, that's absolutely insane. Does that mean people use their credit? Well, beyond living, they use their credit card to even pay their taxes. Some of the most basic stuff.
Right.
And this was well beyond what the expectations were. And I think, we were popping into the end on Friday, and I think maybe this gave it a little bit of pause. I know we're having some follow through today on Bitcoin being down
over
nearly
1,000.
Nearly 1,000 points. Yeah. So to me, this speaks to the last hurrah, Phil. And I think what's happening here is that we're going to show you guys some charts that to get an answer to the question Phil posed to me is why this is 2008 and on steroids. But before I get to that, I'm going to show you not only people spending like crazy is because of this. They have no emergency cash whatsoever. None. And people have been listening to us, and we both live our lives this way. Phil and I are both, I think, extremely conservative in the way in which we live. And we always have emergency money, but we always have also emergency cash, just in case, you need to have cash in the house a little bit to make sure that if, machines go down or people don't trust the bank or whatever, that you're going to be able to get through this until some sort of stopgap gets into place. But people have absolutely nothing. And I think you're getting this thing, like almost like biblical, like, eat and drink for tomorrow we die. And I think this is what's happening to people, Phil, is like, like everybody now is fatalistic. I've never seen such a nihilistic generation that we're seeing now where people just don't care. I'm not going to pay my student loan. Screw it, the government. I'm going to jack my credit card. Screw it. They can take it. Delinquencies on car loans skyrocketing. Delinquency on credit card rates skyrocketing. People are opting out of the system. And I wouldn't really care. I'm like, good on you. The system is really rigged, but, it's going to cause a problem for us. And I'm going to kind of segue a little bit, but it proves my point too, is I saw a really good article. I want to slip it in here. And if you don't mind flipping it over, Phil. So there's actually a battle going on. And I love the way they use the Squid Game thing because it's really going to be binary what's going to happen, Phil. If OPEC wins, what I call OPEC plus, if OPEC plus wins, we're going to go into a hyperinflation and collapse. If the West wins by losing their economic vitality, we're going to first go into the economic chaos. And I think OPEC plus is losing. Remember a couple of weeks ago, I started starting to get nervous about my energy positions, and now we're starting to wiggle here a little bit.
Yep.
And now with these pops, I'm trimming. I had a great run, and now I'm trimming energy as well, Phil, because I just don't I don't trust that energy is going to hold up. I think, with economic recession that we're in or going into, depending on how you want to define it, demand destruction is going to overwhelm production cuts. And China even though I had a chart for this, I just didn't want to make this thing so chart happy. China is imploding. They think China is months away from what's called a Minsky moment. And a Minsky moment, for those who don't know, and you can Google it yourself, is when basically your currency doesn't matter, your credit is imploding, their money supply is rapidly increasing, but is producing no economic activity. And that's a Minsky moment, when your currency does not perform the function it's supposed to in terms of transactions and economic activity. And if China goes, there goes the excess everything on the commodity side. We talked about the CDS and the commodities earlier this week, and I think it's happening. And Phil, I'm going to throw it to you here for any comments, but I think there's some really cool charts that you put together based on some of this research that I did that I think really makes it totally clear what's going to happen here with the stock market.
I'll segue into that with a little comment on China that, people are going on about, this de-dollarization basically, right? And, again, our stance is careful what you wish for, because de-dollarization is going to be chaotic. I mean, will it come at some point, down the line over decades? Probably, but it's going to be a very chaotic process and your quality of life will suffer. But one thing you have to keep in mind is China is a massive net exporter. And as such, they don't want to be the reserve currency. They want to have the freedom to change their currency peg as needed to facilitate their exporter economy. And a lot of people don't comprehend that dynamic. So while, yes, the BRICS, I think you're going to see situations where you have balkanization of currency pools for certain things. But at the end of the day, when you're talking about the reserve currency of the world, still going to be the dollar. And China doesn't want to have any part of that. And people just don't comprehend, I think, those dynamics. So, I think that's really the reality of the whole dollar situation. But going to the charts and the data that you had dug up, and, so Bob said, well, look at the loans and leases and bank credit, all commercial banks. And we look back at 2008, and what you see is you have this steady rise in credit, right? Similar to what we saw here going into our current situation, also going into COVID. And then you get a big spike. Okay, so when those spikes occur, and this chart's a little skewed. This if we were back here, this would look like a gigantic spike, but things are a little skewed in scale because of just what they've done since then, right? Which isn't healthy at all. But essentially you get these big spikes. That's usually when the recession really starts hitting the fan. And the reason for that is a lot of the institutions are going to pop a Fed and asking for money because they're in hot water. And so you saw that in COVID, and you're starting to get a little wiggle here. And that's because of the bank situation and that bank lending window that opened up a couple months ago, right? And that's just the start of it. But the point is that when we get into these situations, and the data is recessionary, the great financial crisis had a 10% debt destruction, which means that $730 billion was sucked out of the economy. Economy also means the markets, okay? The markets are going up because credit's flowing freely. They're going to contract because credit's being destroyed freely. And in this situation, we had the stock market dropping almost 50%. Well, if you look at where we've come from since COVID, and you guys all know watching the show that this was all created out of the COVID panic to try to keep the economy propped up. But now they're realizing this all has to come back out to get rid of inflation. There's no other way. We're looking at a 17% debt destruction here, which means 2.1 trillion will be sucked out of the economy. Remember, they're trying to unwind the greatest money printing program that we've ever seen ever in the history of mankind. Okay, and so what that means is we're going to get about 30 something percent more of a drop, and so that's going to mean something like 63%, I believe it was, Bob. And if we zoom in here, that's going to be taking us down to, actually, let's switch to this chart here. 63% drop in the S&P 500 means we go back to under 2000 down to 1773. And if you think that's unrealistic, you have to keep in mind that's kind of that's just above where we double topped before this market broke out. And a lot of times markets charts like to go back to where they broke out from. So before you think that it's impossible to get down there, and this would be extreme, I would say, but be open to the fact that this certainly could do this technical move back all the way down. And remember, the bond market's telling us that we're in hot water all through 2024. So there's certainly a lot of time for this market to start going lower. The only thing that we don't know is, will the Fed cry uncle and get back to QE? And when they go to QE this time, it's going to be QE infinity. It's going to be yield curve control. And you better just have things that are going to be able to hedge inflation, like Bitcoin, like gold, real estate, because otherwise you're going to be drowning in inflation and you're never going to get out of it.
Yeah, and the thing I want to make for people too is that these things Eiffel Tower, okay? And if we're really going to get this debt destruction, which we are, there's no way around it. 30% of commercial real estate loans are gone. Okay, so saying a 17% reduction in all credit, to me is not a harebrained concept here. So if you took the move up from those double top and you then retrace that lift all the way back down 87% of that, which is typically an Eiffel Tower retrace, that's where you're going to get your number. So if we don't get down to 1700, can we get to 1900? You bet. And so I've always been saying we're going to see a two handle on the SPX here before this recession's over. And remember, even if the Federal Reserve and the politicians start pumping out money, it takes 6 to 9 months to get that to reconfigure. And a lot of this commercial real estate simply is what we call dead assets, because nobody needs them. So no matter how cheap you make the money now or the loans, you still don't need the property, because of the age. And so, guys, you really have to think really hard about this. And if China goes into a Minsky moment, we're not too far behind. And the thing on the dollar too, Phil, that I want to address is that in that article that we didn't show is that China is looking for a reason to devalue their currency, to your point, to protect their export markets. The reason why they haven't is that they weren't sure what OPEC's going to do. And if OPEC Plus can't maintain the price, China will devalue their currency so that their exporters are more competitive. And what that means to the United States is more deflation, because China will export deflation into the United States because they're going to undercut our manufacturers. So it's really kind of ironic. You get lower energy prices, but it's going to be a short-lived good guy because the Chinese are going to come in and wipe out all the domestic manufacturing that they can, or at least make it unprofitable.
Yeah, I totally agree. So yeah, I mean, there's really no win-win here, I think. But we knew this was coming. You have to pay the piper. The reason why we haven't paid the piper before is just because we were able to get away, or the Fed was able to get away with kicking the can down the road with their easing policies because inflation had never been an issue. But this is what 10 years of that does to you. You start to get runaway inflation, and now they have to not only take it back down, they have to make sure they don't get runaway deflation, which is also a concern as well. But I think they're more concerned about the inflation than the deflation right now, because I think at the end of the day, what they know they can do is pump enough money into this thing, and they can reverse course on things like deflation. But I don't envy their position here at all. And I think Bitcoin, this Bitcoin drop this weekend, I think is significant, Bob, because if you look back on the last like in 2022, and we really started to come down from the highs in the Bitcoin bear market, a lot of the moves gapped down over the weekend, the gap being the weekend move because the futures aren't open, and those gaps didn't close. We could potentially be seeing that again, and Bitcoin leads. And a lot of times when Bitcoin's down over the weekend, the markets gap down too, the stock markets. And if Bitcoin loses, I think it looks like they've been selling this 30,000 level. If Bitcoin loses that 26 area, then I think they could unwind this whole move, and then this big rollover that we've been looking at with liquidity rolling over and fair value being so high over its skis, I think we start to see this move start to manifest down.
Yeah, and I think it's a 4 to 6 week move. So we'll just have to wait and see. We'll trade day by day, but definitely macro bearish. And I think your Fed liquidity says it's risk off now too as well.
Correct. Global liquidity is risk off. Fed liquidity is risk off, and we're so far over fair value that it's one of those levels where you have to be short when that fires off, and that's where we're at right now. And it means at least 200 to 300 points lower in the S&P 500.
Yeah, maybe we'll show that on Monday. So, okay, guys, thanks for listening. Hit like, subscribe, hit the notification bell. Come check us out. And if you want to trade with us, just go to tradelikeagenius.com. We have specials running. What we charge for the service is nothing to what you get out of it. This market falls, we have great trades for that. And so we really don't care. Phil and I be macro bearish because we want to share truth with you, but we really don't care day to day if the market goes up or down, okay? Because we have trades. And that's the beautiful thing about trading is we can be agnostic to the direction. That even includes cryptocurrencies. So there's ways in which you can make money if Bitcoin is falling or the crypto market in general is suffering. So there's always opportunities, and we'll help you get through it so you don't have to panic about your portfolios.
All right, guys, that's going to do it. Thanks for watching. We'll see you on the next one. Take care.
Trade Genius.